So there's going to be 4 presentations, each too long, too short. Actually, the short ones will be first, each followed by a Q&A session. To ask questions, please raise your hand through the interface, or you can also send a question to the host via chat. I believe I'm the only person you can send a chat to. All other chat functionality is disabled. The presentations from today will be made available to participants. And if you missed any part of the web conference, you can request a recording. I believe actually you may in fact be sent a link with the recording automatically at the end of this. So let me see here. Everything else out of the way. What else do I have here? Sharing sign-ins is strictly prohibited, so please don't share them. If you have already, then we will crack down on you. And also, there is a strict embargo on media coverage until 9:45 a.m. Eastern Time. Okay, that out of the way, I will now turn over the floor to Gabriele Grego. This is an individual. His fund is Quintessential Capital Management. He first came to my attention. Turn the volume up. He first came to my attention. How's that on the volume? He first came to my attention when about a year ago, actually 2 years ago now, when he presented at Whitney Tilson's short conference, and he presented a short thesis on an idea called Folie. And it's okay. People need to mute here. David Trahan, I don't know who you are, but I just muted you. So as I was saying, this company that he presented the short thesis on quickly went to zero and turned out to be a fraud. And I'm not promising that the same thing will happen today, but I'm sure you will agree that this is going to be a compelling idea. So I'm very much looking forward to hearing it, and I hope that all of the technology works and he is able to present everything here. If not, just bear with us. Gabriele, can you hear me, and can you present your screen, please?
I can hear you fine. As far as Chris' presentation, I was actually waiting for an input from you.
Okay, well, we're all ready to go. So it's up to you. The floor is yours. The screen is yours to share as we did in the walkthrough. So please go ahead.
Excuse me. About the screen sharing, I can hear you guys fine. We were discussing before, and I was waiting for you to give me an okay about the sharing the screen, because I cannot see you guys.
That's fine. You don't have to see anything. Just go to share on the top of the meeting. Mm-hmm. On the top, when you see where it says share.
Yeah.
And then share content.
Okay. Okay, then I can pick it this way. Okay, got it.
There you go. Yeah.
Excellent. Sorry about that. Let me just maximize this so you guys see it as it is.
Glenn, please mute your microphone.
Can everybody see? Can you guys see and hear?
Yeah, we can hear you.
Excellent. Okay. Thank you, everybody, for attending the presentation. Thank you for Vale and Nathaniel to invite me here. And let's go through this presentation. There is a lot of slides. I have a bit of an echo, so I might remove my headphones. So if someone needs to interrupt me, please either Nathaniel just send me a message or something, because I have an echo. Okay, now it's better.
Yeah, it's much better, yeah.
All right. All right, this disclaimer, we have our own disclaimer. Please read it. Okay, for whoever is not familiar with us, what do we do? We're an activist short fund mostly. We do some activist long as well. We focus on what we call catastrophic corporate situations. Very often it's about fraud and criminal behavior on behalf of management. And our way of operating is collecting what we believe is very deep due diligence, investigative due diligence, and finding very serious corporate situations and sharing them with the public, usually by surprise. This is our track record. Some of you may be familiar with some of our other hits. The last hit that we did was actually an Italian company called Bion. It was at peak 1.3 billion euros. There was a very bitter battle between us and the management last summer. The battle was actually concluded by the police storming their offices and arresting basically the entire executive team, and the company went bankrupt after a month. But right now, we're not here to talk about Bion, we're here to talk about Akazoo. So Akazoo is our latest target of our attention. It's a company that's listed recently on NASDAQ, although it's supposed to be, you'll see why I'm saying supposed to be headquartered in the UK, but most of the personnel is from Greece. The ticker is SONG. Okay, in a nutshell, very quickly, it used to be a company called Internet Q. That's the parent company. At the time of writing, the market cap was about $220 million. It went down a bit because of the coronavirus crisis. It's a music streaming company, very similar to, say, Pandora or Spotify, and it claims sales of $145 million and EBITDA of about 10. This is what they want you to believe. So again, as music streaming, they claim to have 44 million registered users, which is a relatively large number for this kind of business, almost the same as Pandora. 5.5 million paying subscribers, 140 million of revenue as we saw, and it claims to grow at a almost 40% compounded annual growth rate. We have a different opinion on the company. Again, we stress this is an opinion. We believe there is something wrong with the accounting, so this may be an accounting scheme. We believe that number of subscribers, number of users, revenue, and profit may be profoundly overstated. We believe the company is probably a fraction of its claimed size and might be making a loss. The service, as far as we can tell, the music streaming service is available only in a handful of companies, and even in those companies, barely ever used. And there may be some round tripping going on between Akazoo and foreign shell companies. The infrastructure seems to be collapsing. The number of employees has been reduced in half in only 3 years, and was starting from a very small base. And the offices seem to be closing almost everywhere. And there are many key individuals and many employees in this company that have ties with suspected fraud or actual fraud. In other words, we believe it may be a scheme orchestrated by management to profit while deceiving investors. What's the evidence here? So we see signs of very suspicious, what looks to us, accounting manipulation. For example, there is cash inconsistencies, and there is a total lack of income taxes, even though the company shows a large accounting profit. The app is unavailable in many of the core countries where the company claims to operate. Disappearing infrastructure, as we saw. There are some suspicious related party transactions, and there are links with former fraud. And serious allegations by field sources contacted by QCM. The brief history of the company was founded in 2000 by Panagiotis Dimitropoulos as part of a company called Internet Q. Internet Q IPO'd in London in 2010. In 2015, it acquired a company called R&R for $70 million with a private placement provided by a British fund called Tosca. And in 2016, early 2016, a UK blog called shareprofits.com actually made what looked like an expose against this company, essentially accusing it of fraud. They questioned the true nature of the company, how large it was, and all that. The company made a response, which in our opinion was not convincing. And then very quickly after that, a private equity fund took the company private. We didn't hear almost anything about this company for a few years. And then all of a sudden, we see this company popping up again, this time on NASDAQ, where it listed in 2019 through a reverse merger. So we believe that this is its second life. The first life as a public company was Internet Q, and this is its second life. And hopefully we're going to put an end to it. This is what we believe it may be going on based on the evidence that we saw. So our opinion on the situation is that the company does have an existing music streaming platform. It has probably a very small number of real clients, real users, and some real suppliers. But there may be some shell companies overseas which we believe may have some undisclosed management control with which the company may transact and create an impression of larger revenue than actually it is. This may be both shell companies and also payment processing companies. So what's the evidence? First part of the evidence is the financial analysis, and there are some glaring accounting anomalies. What we always see when we're looking at this kind of situation is, first of
Appears we lost Gabriel there. Gabriel, can you hear me? Well, let's just give him a minute to hopefully sign back on. Let me try him. Everybody else, please mute yourself. There's something going on there in the background. Somebody who seems to be doing something in the kitchen. I thought I'd muted everybody, but maybe not. Gabriel? Okay, he's still going through the thing, but we can't hear him. I got to call him.
Hello?
By the way, guys, as we're waiting, this stock is down 33%, so somebody's paying attention. And again, remember these presentations will be available after we're done here.
Nathaniel, through the system?
Yes. Yes, I can hear you. It's fantastic.
Can everybody hear me?
Yeah, we can hear you.
Excellent. Okay, so let's go back to the presentation. I'm going to go back to the cash because I don't know where you guys lost me.
I believe the last, let's start here where there's like one or two slides from where you left off.
Okay. Okay, financial analysis. So what we usually see in this kind of situation is that we see a lack of cash mostly. As you see here, on the blue line, you see net income, and the brown line is cash flow from investing. So cash flow from investing year after year tends to be a lot larger than net income. So even though the company shows an accounting profit, cash is actually burned year after year, every year. Where is the cash going? It's going in intangible assets, large amounts. We believe most of this is software. And it's going to receivables. As you see, receivables have been growing very fast and ballooning lately, even though if you compare DSO, which is days sales outstanding, basically is a receivable as a percentage of yearly sales, you see that Akazoo has almost 4 months of receivables versus all of the competitors, which only have about a month. If you see Spotify is about a month. So they have 4 times as much receivable as their competitors, and there is no reason really for that in our opinion. And then the other thing that's very worrying is that Akazoo pays no taxes on their income statement. We find no taxes year after year, even though they have declared a 22 million cumulative profits over these last 4 years. So why do they pay no taxes? And then the next very interesting piece of evidence about what we call numerical analysis. So the idea is that every time you have an app that has to do with the public, you should see some kind of metrics out there which maps more or less the trend and the extent of the company presence in the market. You'll see exactly what I'm talking about. We use something very similar to show what was happening at Folly. For example, here, you can see what the company is claiming in its presentation. You'll see that they claim more or less, if you look at the first line, premium subscribers, 4.3 million. By now, they're claiming 5.5, because this presentation is from last year, which is almost the same as Pandora, which has 6.8 million, which I'm sure a lot of you are familiar with. So Akazoo, in terms of paying subscribers, claim to be approximately the same size as Pandora. But then, if you start checking, for example, the number of users per number of reviews. So in other words, when people download an app from, say, the App Store, like say you want to download Spotify, you can leave reviews, give it a number of stars, and you can write a comment. So there tends to be a ratio approximately 1 to 30, 1 review per 30 registered users. And you see in all of the competitors that we identify, we have 4 of them here, Radio, SoundCloud, Pandora, and Spotify, that number is, more or less 30. Some of them have a few more, some of them have a few less. Check out with Akazoo, the number is 530 more or less, which is 17 times overrepresented. In other words, for all the competitors, have 1 review per 30 declared users. For them, you have 500, which means that either their users don't like to leave reviews, or they're declaring is overrepresented. The same thing when you look at revenue per employee. Again, you see these companies tend to be very not capital intensive, not labor intensive companies, so very few people work there. But even Spotify doesn't even reach $2 million per employee, and Pandora is a lot less than $1 million, and all the others. But for Akazoo, they claim to have $5.5 million per employee. So the revenue, the number of employees that they have relative to revenue is too low. Keep in mind that companies like Apple or Facebook, which are supposed to be among the top in the world for this metric, have a number which does not reach even $2 million per employee. So this number is off the chart, in our opinion. If you look at other statistics, you see the same incongruence and the same outliers. For example, if you check the number of registered subscribers per employees, also, you see the red line on the left is Akazoo, is many times overrepresented. If you check the number of users per employee, that too is a lot overrepresented. And then you look at visibility in social media. Now, social media is an important marketing channel for this kind of consumer-facing application. So you would expect these guys to have a following. Again, we're reminded to have similar metrics, similarly crazy metric as Pandora, which is supposed to be a company of similar size in terms of paying subscribers. Instead, you see Akazoo on Instagram has only 243 followers. Pandora, which is supposed to be around the same size, has 364,000 followers. So Akazoo, according to this metric, is 1,500 times overrepresented. Other social media platforms, for example, Facebook, look at the number of likes on their page. Akazoo has barely 20,000 likes. Pandora has 7.5 million likes. So again, Akazoo seems to be 370 times overrepresented in social media. All of this cannot be by chance, right? I mean, one of these indicators may be off the chart by chance, but you have all of them, they're all pointing in the same direction. The direction is that the number of users, the number of paying subscribers, and the revenue is probably grossly overstated. So an exercise that we did is we said, okay, based on the type of visibility that we have in social media, based on the metric that we saw before, can we extrapolate a more realistic size of subscribers? And we believe that this, the size may be around 400,000 versus 5.5 million claims. So the real number, in our opinion, is at least 90% smaller than they're declaring. This is Google Trend. Now, Google Trend is a very useful tool. It tells you how frequently a keyword has been searched into Google, and it even tells you where it's been searched. Now, we put from the beginning, from 2004, how popular has been the term Akazoo on Google Trend. And you see that the interest for the app spiked around 2008 all the way to 2012, more or less, and then from then it went barely down, and now it's barely detectable by Google Trends. The other interesting thing that you see is that even this app, which is again a music streaming app that claims to be marketing aggressively and selling aggressively in emerging countries, you'll see that the overwhelming majority of interest in Google Trends originates from Cyprus and Greece. And then other countries you see underneath, Spain, Malaysia, and Brazil, they're barely detectable, which is very interesting because the only thing we know that is very prevalent in Cyprus and Greece for this company are the employees, not necessarily the users. Now we compare Google Trends for Akazoo with other two competitors, which again are the same size. One of them we saw is Pandora, the other one is Deezer. Again, these companies have about the same size in terms the same declare sizes. There is no reason why they would have widely different interest in terms of Google search. But then you see on both accounts, both against Deezer and both against Pandora, which are both supposed to have the same size, you see that Deezer and Pandora show up in there with a stable trend, and Akazoo barely shows up, is barely detectable. Again, this is an anomaly, and it's not clear why this is happening with that kind of users. Another metric that shows you exactly the same thing. Again, so I'm showing you the same concept proven by many different unrelated data points. These are software which are available to everybody, most of them for free. You can check them yourself. It basically tells you how many times an app has been estimated to be downloaded. One of them is Sensor Tower. You can check them out, sensortower.com. You can do the check yourself. And you see, you enter the name Akazoo. It detects the app, so it sees that there is an app. And but the number of downloads estimated is below the minimum threshold of 5,000. So in other words, they believe that there's been less than 5,000 apps downloaded as of December 2019. It also gives a score in terms of visibility and how international it is, and an overall quality score that they call sensor score. And Akazoo takes a great grade of F. Somebody may question this guy, so maybe let's use another company that's completely unrelated to Sensor Tower. This is called Mobile Action, and it does exactly the same thing. It estimates the number of downloads. Again, this estimates how many apps have been downloaded in December 2019. Here, there is no threshold. The app is found, Akazoo on the left, you see it, that's the logo. How many times it has been downloaded in 2019? 40 times. Only 40 times. Keep in mind that these guys claim to have about 50 million users and growing at about 30% per year. So you should have millions of new downloads every month, so you don't see them. Further evidence, app reviews. So, when you're downloading from Google, and you're downloading an application from Google app, you can write down a review. So we check them out, and what do people think about the apps, and what kind of comments do they leave? And you see that there are very few reviews first of all compared to competitors, as we saw before. A lot of those that you see, we question whether they're real or not because they're very short. They say only good, great, or nice, that kind of stuff. So in our opinion, those are fake reviews. But very interestingly, which are the first reviews you see if you enter the Google app? This is the Google app page. It's just a screenshot. Is the first reviews that I see, the most relevant. And you see three names here. Chris Spilotopoulos. Who is this guy that gives such a glaring review? Okay, you see there on the right, that's the LinkedIn page. Chris Spilotopoulos is the senior solution architect where? At Akazoo. Interesting. Who's the next review? Yannis Karalis. Who's this guy? Again, he's an Akazoo IT guy. You can see there on the right. And finally, right underneath is this guy called George Servos. On the right, you can see the LinkedIn, the Facebook profile, and you see the guy very elegantly sticking his tongue out. And that's supposed to be the content curation at Akazoo. So these are really funny profile, clearly given by the company's employees. And the only reason why they would do that is if they're not actual reviews, or at least not good reviews. There is more evidence. Infrastructure is disappearing. So what's happening here? Offices are disappearing, and workers are disappearing. First of all, this is the headcount for the company Akazoo in 2016. 45 people used to work there. It's still a very low number, extremely low number. But even though the company is claiming to be increasing at something like 30% per year revenue, and users almost the same tick, every year these numbers go down about 20%. And as of 2018, there were only 26 employees. We don't know what's the number now, but we estimate it's a lot smaller than that. These are the subsidiaries of Akazoo. As you see, a lot of them are based in less than transparent jurisdictions. You see there Ukraine, Ghana, Cameroon, Cyprus. A lot of the revenue comes from Cyprus, for example. We have a lot of doubt about the authenticity of this revenue. Now, let's talk about the offices. This is supposed to be what we understand the headquarters. Why? Because if you download the SEC Form 20F, which is the annual report, you see that the address that shows up is 96 Kensington High Street in London. That is a screenshot. Also on the website, the company claims to be based in 96 Kensington High Street. On the right is the screenshot from the company's website. So the first thing we do, and now it's become our kind of like distinguishing flag, is we actually show up and see what's in there. So that's myself right outside the headquarters of Akazoo in London, in this place called the Pavilion Center, which is again in 96 Kensington, London. And guess what? Guess who is there? Guess who is not there? Definitely Akazoo is not there, because we spoke to the receptionist. As many as 4 employees used to be there until early last year, but the company closed down and everybody left. So as of now, there is no Akazoo at the Pavilion Center. If somebody new, we can hear a lot of background noise. Thank you. So there is no Akazoo in its own headquarters. Well, there is another address that shows up in the 20F. That's an address in Luxembourg, where the company is domiciled. It's 19 Rue de Bitburg. I actually lived in Luxembourg for a while, so I'm familiar with the place. We showed up in there. We took some photographs. We checked on the intercom. No trace of Akazoo whatsoever. There is no Akazoo in Luxembourg. Now, what we believe is this may be the address of maybe their legal advisors, maybe some kind of legal domicile, but certainly there is no operational address in Luxembourg, as far as we could see. So where are they? They're not in London. They're not in Luxembourg. We'll see soon that they're not in Ukraine, even though they're supposed to be there. We believe we found them, and we found them in Greece. I'm sorry, parenthesis, this is another one. This is the address of R&R, which is the acquisition they did in 2015. It's supposed to be some kind of a fancy acquisition. Again, there were 2 addresses showing up, one for R&R in number 10 Pentonville. Nothing was there. I went myself, as you can see. Also number 14 Old Queen Street in London. They left the place. So all of the places that we saw in London, Akazoo had left. And this is where we think we find them. These are the address in Athens of Internet Q. Internet Q is their former parent, and they're based in Athens, in a nice neighborhood in Athens called Psychiko. I showed up myself. On the left is myself opposite the building, and on the right is myself opposite their office address. You can see on the intercom, there is not even a sign. There is a tiny intercom button, and it says Internet Q. It doesn't say Akazoo anywhere. But when I asked the door person downstairs, where is Akazoo, they actually told me that this is their office. So they try to look like an international, multinational company, but in the end, they only seem based in Greece. We mentioned Ukraine. Ukraine is important because it was an important office for R&R, which is their acquisition in 2015, which they paid $17 million for. And very interesting, you see that a person called Tatiana Ostapenko on LinkedIn, who claims to be the finance controller and chief accountant of Akazoo, as you can see there, well, she writes that she's open for offers, and she says, reason for stopping cooperation, headquarters is currently closing business in Ukraine. So Akazoo is also, according to what their finance controller is saying, they're closing business in Ukraine as well. So they close in London, they're closing the Ukraine, and they seem not to be present in Luxembourg. More evidence. So a lot of people, the first question that we get when we see this kind of situation is, why don't the accountants understand what's going on? Well, in theory, accountants should probably detect these things, but in practice, sometimes they do not. There are 2 reasons. One time is because they're prone to make mistakes, and you will see specifically what looks like a mistake that Akazoo's auditors have made in the recent past. And the other problem is the company, as you see, is domiciled in Luxembourg. It's headquartered in London, theoretically. In practice, they're not. But most of the revenue doesn't come from other countries. It comes from countries like Cyprus, the Ukraine, maybe Ghana. Those places typically are not audited by the large Big Four or respected auditor that audits where the company is domiciled and then headquarters. They're audited by small shops of local auditors, which sometimes can be unreliable. We saw this happening in Foley when the Asian auditors were auditing $1 billion, which turned out to be 50 million. And we saw this with Global, which is another fraud that we exposed in 2015. In case of Akazoo, the auditor is this company called Crowe LLP. They signed up all of their financials since 2015. You can see there their website, and on the right, their signature on Akazoo's financials. But guess what happened? Recently, the SEC charged Crowe LLP for what seemed to us like some serious issues. So essentially, they gave a clean bill of health to this company called Corporate Resource Services, which they were auditing. But according to the allegation of the SEC, the audit team identified pervasive fraud risk, but failed to essentially blow the whistle. There were many related party transactions. There was a lot of fraud risk. There was problem with the recognition of revenue. And Crowe was not even independent. As it turned out, they were doing business with with the subject of their audit. Now, this is worrying because it really reminds to us like what's happening, what may be happening at Akazoo. Crowe received a fine of 1.5 million. And that's why you should always look at the audit with a critical eye. Moving on.
Hey, Gabriele, sorry to cut you off. We're running a little bit short. Is there a way you can speed this up just a tiny bit? Okay, thanks. Go ahead.
I'm going to speed up. Okay, we can take this off. Okay, this is an important part, so I'm going to speed it up. The company claims to operate in 25 countries, including core markets like Poland, Russia, Malaysia, Thailand, Indonesia, Ecuador, Brazil, and Mexico. That's what they claim, 25 countries. This is their slide that shows the countries in the world. But the problem is when we try to connect, we could only do it in a handful of countries: Poland, Malaysia, Indonesia, Greece, Cyprus. In all the other countries, almost all the other countries, they said that the service is not available. This is a wrap up. You see in Poland, you can register, but there is almost no volume. In Russia and Brazil, the app exists, but you cannot register. In Indonesia, you can register, but there is no volume. Thailand and Mexico, you can't register. Greece and Cyprus, you can register. And Malaysia, you can register, but there is no volume. So we don't see 25 countries here. We only see a handful, and on a lot of them, you cannot register. And the company is supposed to be doing millions from these countries. So we believe that they're lying on their geographic reach. We also checked with one of their suppliers, Sony Music, about their copyrights, and we see that they have, at least from Sony Music, copyrights for only 5 countries: Greece, Cyprus, Poland, Ghana, and Malaysia. For other countries, through Sony, they don't have copyright. So either they buy somewhere else or they don't have it. So either they're lying on a number of countries where they're selling, or there may be a problem with copyright breach. It's not important. About GDPR rules, well, we heard that through their partnership with Viber, it's possible that some of the clients were being spammed with promotion from Akazoo. If this really happened, it would violate GDPR. This is interesting. Ties with former fraud. You see Global and Vale. Global was a fraud that we exposed in 2015, but Vale was a company that collapsed because it had big problems with receivables. It was not proven a fraud, but it was facing class action lawsuits which were claiming fraud. This is what happened. Both companies went down. Investors lost everything. Well, you see that the CEO, Apostolo Zervos, is a former manager of Vale, which we find very interesting. And we find that 23% of the workforce of Akazoo either worked at Global or worked at Vale. Both of them either frauds or suspected fraud. Solution System Media, because we're in a hurry, I'm not going to go through the whole thing, but basically InternetQ, which is Akazoo's parent company, was doing business that had to do with revenue collection and receivables with the payment processor, which is related to the company's CEO. To InternetQ CEO. We believe that it's a big problem because it may create conflicts of interest. Conclusions. We believe Akazoo is a far smaller company than it claims to be and a rapidly shrinking one. Official figures show incredible discrepancies between objective data that we collected and what the company is claiming. Accounting and audit history show very scary red flags, and there are allegations of fraud and other serious breaches by field sources. In general, we believe that Akazoo is a scheme orchestrated by management, profit while deceiving investors. What's likely to happen? If we're right, the financials may be false. The company has made serious misrepresentation in their official filings. It's probably gross exercise and deception to investors, and therefore the equity might be worth zero. Akazoo founders this is the final thing, last slide, just for a little fun. That is a screen page of the Akazoo page for Dimitris Panagiotis, which is the CEO of Internet Q, Akazoo's parent. And you can tell the last song he's been listening to. And when we actually checked out this page, you could see that the titles were End to the Lies by the Great Escape Artist and Being Caught Stealing by this guy, Richo de los Habitual. So we believe that this is very funny that that's the song he's listening to. So maybe it's time to come clean. That's what's in his mind.
Yeah.
That's it. Thank you very much. Open for questions.
Thanks, Gabriele. I was going to say maybe some kind of Freudian thing in there that guy was with his musical selection. So in the interest of time, actually, I thought that we would move right on to Nate Anderson's presentation, and then we can have the Q&A of all, maybe for both of you, after Nate's done.
Okay.
Who is X? Oh, here he is. Great. Fantastic. Nate, do you hear me? And do we hear you, more importantly? I love how he's on here as X. Nate, can you hear me? I can't hear you. Hold up. Yeah, I'm not hearing you. Can you maybe call in or something? Oh, wait, here we go. Try it now. Here you go, Nate. Go for it. Here, we can hear you now. Yeah.
Perfect. Great. Can you see the slides?
Yes, we can.
All right, perfect. As always, excellent work by Gabriele. Hopefully, similar outcome as last time when everyone got arrested. Wouldn't be surprised. So let's get right to it. Thank you, Nathaniel and ValueWalk, for hosting us. My name is Nathan Anderson, founder of Hindenburg Research. We see over 90% downside in shares of New Pacific Metals, which trades on the TSXV and the OTC. And we see up to 45% downside in Silvercorp Metals, which trades on the New York Stock Exchange, ticker SVM. So here's our legal disclaimer. Hopefully you got all that. Basics on the company. So New Pacific is an exploration stage silver mining company that's roughly 10 years away from potential commercialization. So no revenue, no earnings. Its CEO, Rui Feng, also serves as chairman and CEO of related company Silvercorp, which is a relatively large silver producer. Right now, New Pacific's only active exploration projects are in Bolivia. So since making its flagship purchase in the country in 2017, the stock has ripped about 400%, trades at a market cap of $660 million, at least for now. And Silvercorp trades roughly $800 million market cap. So that valuation has been fueled by multiple paid stock promotion campaigns and newsletters. They've touted that the company has found a mountain of silver in Bolivia, and it's a world-class project. So by comparison, we see roughly 85% downside purely on a fundamental basis. So the company is egregiously overvalued relative to its exploration peers, up to 17x its comparables. As we won't, this is in the slide deck, but we won't show it, but we also hired a technical consultant to do an analysis on the mine as well, and that's going to be certainly available in the PDF for download. So massive outlier relative to its exploration peers. And that's if you believe the numbers. So there are some management red flags. The CEO, Feng, had previously been accused of inflating silver grades at Silvercorp and of questionable related party deals. Those allegations led to a massive intimidation effort against his critics, including use of litigation and, in one instance, state influence to have a short seller jailed in China for 2 years. The Globe and Mail at the time reported that Silvercorp paid for the local police investigation and was given standing at the one-day closed-door trial for the short seller, who subsequently served 2 years. So as we will show, there's parallels. For example, we found that a supposedly independent geologist who prepared almost all of New Pacific's technical report for its flagship mine actually worked for related Silvercorp for 3.5 years. Silvercorp also sold New Pacific 3 projects, that were all initially hyped up as showing great promise with high-grade mineralizations, but all fizzled and were either abandoned, sold at a loss, or reverted back to the local government in China. So now, the latest exciting project is called Silver Sand in Bolivia. It's the company's flagship project, and also it has several nearby Bolivian properties. Part one, we don't think New Pacific has control over any of its Bolivian projects, and investors seem entirely unaware of this. So going back to 2017, things started off fairly well in Bolivia. The company bought a Bolivian mining entity called Alcira from Chinese owners. It paid $45 million for what was a pretty small 3.17 kilometer project, but it soon expanded and announced a massive deal with the state mining company called Commonwealth to work 57 square kilometers of land. The deal was reportedly the first foreign company to sign a new mining contract with Commonwealth since Socialist President Evo Morales had taken power about a decade earlier. And the company seemed to have a great relationship with Cesar Navarro, who was the Minister of Mines at the time. Navarro held 2 signing ceremonies to announce the landmark deals with the company. At one point, New Pacific's president praised Cesar Navarro on the deal, and everything seemed on track for legislative approval, which was required in order to fully ratify the deal. So they sent it to Congress in October 2019, hoping to get it ratified. However, the administration they were working with was later ousted in what was described as a coup. So this picture in the background, that's the electoral court building in the Potosi region where New Pacific operates. Protesters burned it to the ground, which hopefully gives a sense of what they were thinking about the situation. So the new administration accused the ousted administration of corruption, specifically relating to its deals with New Pacific. The new administration accused Cesar Navarro of being in a corrupt alliance with New Pacific's Bolivian subsidiary, Alcira. President Evo Morales and Cesar Navarro then fled to Mexico. Again, investors in the company seem to be largely unaware of all of this, and the company hasn't exactly made it clear. They've disclosed in a risk factor that they need to get their mining contract approved by the legislature, but aside from that, we could find no mention of a coup overturning the administration they've been working with or any of the other political upheaval that has happened. So where are we now? Our base case is that New Pacific's allegedly corrupt and allegedly illegal dealings with the past administration are not going to be supported by the new administration that ousted them by coup. We spoke with multiple high-level political figures and legal experts as part of our review. So in this slide, you can see we spoke with the head of state mining company Commonwealth. He was the former head, who told us that New Pacific's contract is suspended and that he personally doesn't think it will get approved by the legislature. We also spoke with individuals like a local journalist who had flagged specific signs indicating corruption, including that the new deal was moved very expediently and on very favorable terms. In fact, those terms are now under some debate because they were viewed as being more favorable than actually allowed by the Constitution. We also spoke with a political advisor to the new government who confirmed that the dealings with New Pacific showed signs of corruption. As he alleged, there was a group within the Mines Ministry and the government called INTI that was accepting money from private interests. We also found, as part of our legal review, that New Pacific may have openly violated Bolivian law on its purchase of all of its concessions. So backing up for a minute, a little primer on Bolivian law. Unlike countries like the US and Canada, where a junior exploration company can just develop a property and sell it off, in Bolivia, all transactions must be approved by the state, so no private concession sales allowed. So New Pacific subsidiary looks to have purchased mining concessions without state approval, which is likely not permitted. So do we think the company engaged in private transactions? They paid 85 times more for their entity Alcira, which was the Bolivian entity that held its small flagship project. So they paid 85 times more than the previous holders, despite the entity having almost no other assets. And the previous holders did very little exploration work on the property, drilled about 8 holes, totaling a couple thousand meters. So if not the concessions, what on earth were they paying $45 million for? But that being said, we found another legal issue that could cause a problem, namely the prior owner, that the entity that New Pacific paid $45 million for, already had its concessions stripped on what New Pacific now describes on its flagship property, and those concessions were never fully restored. So during the time that New Pacific actually acquired this entity, they were acquiring not just concessions, but an entity that had a contested interest in concessions. So at the time, Cesar Navarro, the now ousted Minister of Mines, had actually intervened to overturn the revocation of those concessions prior to the sale to New Pacific, but he only completed part of the process. So we spoke with a former state mining authority legal source that told us that the concessions in New Pacific's flagship property are still revoked, and that the company has likely been operating outside the law for the last 5 years. Again, this didn't seem to be a problem when the friendly administration was in there, but that has now seemingly changed quite dramatically. And we see in New Pacific's press releases that they openly acknowledge acquiring concessions, which again looks to be illegal in Bolivia in violation of the Constitution and several other related laws. So we spoke to a lot of people as part of our research, including, in this case, a local cooperative miner who also herds llamas next to New Pacific's flagship property, and he confirmed signs of corruption relating to the deals based on his conversations with state mining company Comabol in particular. He said that Navarro and Comabol were going around essentially saying all of the local property belonged to Alcira, New Pacific's subsidiary. We also spoke with senior political leaders. So when we brought these issues up with the former Speaker of the House and prominent member of the Legislative Majority Mass Party, he said it sounded very serious and suggested he may open a parliamentary investigation into the matter. So despite how obvious this may all seem, Bolivia is still a relatively unpredictable place. It's ranked 123rd out of 180 in Transparency International's corruption rankings. And we had one instance where we spoke with a Bolivian lawmaker who seemed to be extra helpful. So we had actually mentioned the issues of Alcira and New Pacific's contract, asked him where they were in the process, and he essentially offered what seemed to help us either get the contract passed or revoked, depending on our interest in the matter. So we asked him if his friendly offer would come at a price, to which he responded, yes, exactly, and that he could work together with the Senate to see about achieving those interests. So all told, we have that conversation recorded, by the way. All told, we came away from that with the belief that things in Bolivia, regardless of rule of law, might be certainly malleable, and the outcome of the situation at least has some uncertainty. So we also spoke with the Minister of Mines, Carlos Hualpa. He's the new Minister of Mines, who in January alleged a corrupt alliance. He was somewhat more conciliatory than in the January conversation. He said that the company had been in touch with them trying to rescue the contract deal, but he was insistent that if a new deal was reached, the Bolivian state's percentage share of the production or the profits would be significantly higher. So, so regardless of the outcome, we look at it in 3 different scenarios. We see either 1, a total revocation of the contracts in mining areas, which is our base case. We see a chance that there is a renegotiated deal with Comabol and the legislature, which would be on far less favorable terms in all likelihood. Or 3, and we see this being a very, very low chance, but that the deal somehow passes through Bolivia's legislature as is, and the company has kind of full claim and title to its concessions. So we're going to move a little bit more quickly, just in the interest of time, but the full presentation report, they'll be posted on our website, and Nathaniel and Valuewalk may also post it as well, I imagine. So we've covered at least high level on some of these issues, including the very close relationship between Silvercorp and New Pacific, including some of the historical allegations of inflation of silver grades. And so as part of this, there's a Globe and Mail article that did a great job detailing how the BCSC, the British Columbia Securities Commission, investigated the company, found irregularities, and those are posted online, available on the Globe and Mail website. One red flag that we didn't go over in the introduction is that two key individuals in the company's Bolivian operations, including New Pacific's country manager, worked at a nearby public mining company that itself was publicly accused of inflating silver grades. So all told, we find it concerning that there's a management team that has been historically accused of inflating silver grades that is working with key individuals in its Bolivian operation that have also been accused of inflating silver grades. But moving on the balance sheet side, let's pause here for a second. I do want to mention that Rui Fang, CEO, has a habit of facing off against critics, trying to silence them, again, using state influence, using litigation. And we have seen that in other cases. MiMedx is a recent example where an executive team decided to kind of go all out, attacking their critics, and that situation ended with the executive team being indicted for accounting fraud. And the point being that a lot of times that is a red flag in and of itself when we see management teams go after critics rather than just responding with facts and responding with their version or their view. That is a sign of a management team that is often desperately trying to avoid transparency. So getting over to the fundamentals, we did a balance sheet analysis as part of that work just to show that the company has about 30 cents a share Canadian in liquidation value. That includes cash, bonds, and stock. This is a reiteration of the previous slide. And we also hired an expert consultant to do a technical report. And that analysis led us to an estimated value of 29 cents a share for the company's key project, the Silver Sand project. So, and I'm not going to get into all the technical details, but again, it's all available. So in sum, if you had full faith in management and that the company believed that the company controlled all of its mining concessions and all of its properties in Bolivia, we would see 85% downside. But we think there are management red flags. We think there's a good chance, greater than 50%, that they will own absolutely nothing in Bolivia due to political risk. And all told, when we weight the different scenarios, we see over 90% downside to New Pacific's shares. It should be noted that Silvercorp owns almost 30% of the company, which comprises at least 23% of its market cap as well, if you just do kind of a direct calculation. So we are short both New Pacific and Silvercorp. And that's pretty much it.
Fantastic. Thank you so much, Gabriel. I'm sorry, Nate, Mr. X there. We do have a couple of minutes for questions. I am not seeing any, however. So perhaps then, in the interest of time, how did you find this? I guess is my question. How did you come about this?
Is that for me or for Nate?
I think.
I'm sorry. That's for I forgot that you're on too, Gabriel. For either of you, for both of you, actually.
Nate, go ahead. Do you the honor?
Yeah, no, I mean, we've always kind of kept an eye on this management team. Again, whenever our starting point is often the people and finding kind of individuals that have red flags or have engaged in historically questionable practices, and then just seeing what they're up to next. So we've kind of lightly followed the story, and that led us to a situation in a country with a massive undisclosed or underdisclosed political risk. Not to mention that we're talking about a story of a kind of corruption scandal with a U.S. and Canadian listed company that has at least furthered the toppling of a foreign government, and we thought that would be relevant and interesting.
Okay. Yeah, whoever is typing there, sorry. I thought I muted everybody. Gabriel, what about you? Do we have him there?
I think you muted me as well, but I.
Oh, no, you're fine. We can hear you now.
Okay. Good. Well, I always monitor the market, and I ask people around every time I see a person. And I love Greece, by the way, and I go on vacation there a lot. And so every time I meet a person, I usually ask them if he knows any fraud. And in this case, there were a collection of rumors. And then it made me curious, and I went to see what happened to this company. What was the history? Because you always want to check the pedigree. And the pedigree of this company, Akazoo, is that it used to be called Internet Q. And actually, a friend of mine, which is Tom Winifred from the blog shareprofits.com, had already pretty much caught Internet Q as a fraud. And I went to read the report. It was very well written, and I agreed with everything it said. And I couldn't believe that these guys had the chutzpah of doing the same thing all over again with the same company, just with a different name, in the U.S. markets, no less. So basically, you keep track of the same people. Also, you see some people work for fraud that we exposed in the past. People, unfortunately, tend to keep behaving in the same way. So if you keep track of them, you'll find other frauds.
Interesting. Okay, cool. Well, there you have it, folks. That's a couple of actionable ideas, both of which have already moved in the pre-market. So you're welcome. But the apologies for the technical issues. I was hoping that people here would be actually able to see these guys on screen, but when I was setting up the settings, apparently I'm disabled video for everybody, but at least the presentations are visible. And a reminder again that these will be available to all of you. Okay, here I do have a question that came in from somebody for Nate. How confident are you that the Canadian regulators will do anything about these frauds? Can't they just go on and on into perpetuity?
I do not bank on any regulatory intervention for any thesis. So even to the extent that regulators look into these matters and act on them, the regulatory process is often very slow. I mean, in the U.S., the statute of limitations on fraud is about 5 years, and investigators will regularly investigate 3-4 years and kind of make a decision at the very last minute on whether to prosecute. So from an investment standpoint, reliance on regulatory intervention is a losing bet, in my opinion. However, I think this is a situation that is a little bit different in that the Bolivian authorities have a strong say in the direction of this company and what they're capable of doing. And I think they have thus far spoken pretty clearly. And there's a material risk that investors are just almost entirely unaware of.
Very cool. Thank you, Nate, and thank you, Gabriel. Wow, that was really something. Okay, let's move on now to the long side of this, now that we got these short guys out of the way. Next presenter is Maj Soueidan of GeoInvesting, and his focus is on small caps, in fact, micro caps. And I had Maj on the podcast a couple of months ago. And I'm now actually trying to find where his, there he is, so I can unmute him. Maj, can you hear me? Great. Unmute. Yeah, go. Awesome. So, yeah, I was just saying you're up, you're focused on micro caps. And you have an interesting one here that is very contrarian in light of what's going on in markets and with the coronavirus and everything. As we all know, you know, the coronavirus has affected wide swaths of the economy and of markets, but one area that seems to be particularly impacted is the hospitality industry and restaurants. And this is something that has been completely decimated. A lot of these little restaurants or even bigger restaurants may not come back online at all, even when the quarantines are lifted. So, but this is a very contrarian idea that you have, but you make an interesting case. And so I think what I'll do is I'll just turn it over to you and let you take it away.
Yeah, nice. Can you hear me, Nathaniel?
I can hear you fine, yes.
Yeah, so I think I'll go over my quick pitch with you, and then maybe a little bit about the business, and we can, I guess, do a dialogue. I think in terms, just digging deep into the company with some questions, just going back and forth, I think, right?
Okay. Are you able to share your presentation on this?
Yeah, I'll do that. Yep, I'll do that.
Sure. Awesome. And then then we can walk through it.
Yeah. So I'll do that in a second. So let me get that up here. Share content. Boom. Let me know when it comes up, man.
Okay. Awesome.
All right,
I got it. Yep.
Cool. And just make sure you can see the quick pitch slide. Does that come up for you?
Yep. See everything.
Great. Excellent, man. Yeah. So the name of the company is Intouch Insight, and actually here it trades. It's 26 cents. Trades in the OTC, QB, and in Canada INX.V. It's 26 cents right now. Has, nice little tight capital structure. 22.5 million shares. Not much dilution. And they're headquartered in Canada. I've been public for 17 years. Founded in 1992. Good insider ownership of 30% there. So, why do I like the company? So it was interesting. We were talking before, maybe 2 months ago, when you kind of talked about me coming on this thing. I had a different stock in mind, and then due to what happened here with COVID and everything, I said, well, this one might be an interesting play because the stock fell so much. So this is a pretty, I think, simple and straightforward story. Insight is misunderstood customer experience management.
By the way, Matt, sorry to cut you off, but you have a gray box here covering up the slide.
Is that better?
No. Yeah, there it is. Great. Okay, perfect. Is there a way you can blow this up a bit?
Let me try.
The box is back.
Let me try it. How about now?
At least we can see yeah. So this is fine. But friendly reminder that Madge is long this idea, not short. So
yeah.
Where you go shorting a 20-cent stock. So yeah, go ahead.
Let me try and do it like this here, see if that's better for you.
Yeah, that's it. But now we got the gray box in the way there.
You know what? Let me just.
Great, perfect. Yeah, that's it. Lovely.
All right, hold on 1 second, man.
Oops.
Oh. Sorry about that.
No worries.
Try and had it working earlier.
All right. Well, this is better than nothing, so we can go with this. And again, reminder that we do have this. This will be available for people to download afterwards. So
yeah.
Go ahead.
So you can see the slide, though, right?
Yeah.
Great. Yeah. So to me, Insight's a misunderstood customer experience management audit compliance company. I'll get into what that means in a little bit. With nearly 100% recurring or repeatable revenue. So you have aware it's a stock that I think poised to increase to at least over $3 over the next couple of years. Versus a 26-cent stock right now. This opportunity basically has arisen from a 60% drop in the stock's price due to, I guess, possible business interruption, short-term interruption from COVID-19. Prior to COVID-19, Insight was inflecting on sales and earnings. So I think investors with a time horizon of more than 60 seconds are going to be handsomely rewarded with the stock, and you'll see how I'll show you later also how it compares against the valuation. Kind of silly, actually. It's ridiculously undervalued when you look at other companies in the industry. But I think it'll be useful to take a look at the business, understand the business at first, and a very quick overview of the business, and then we can get into all other stuff here. Yeah. So, business at a glance. What do? They simply just capture information from various touch points, and then they do that to help improve customer service, increase sales, and improve business processes and help the clients comply with regulations. And then recently, because of a new part of the business, they can do some data analytics. So if we go over to the the recurring, and everything's recurring, by the way. So if we go to the recurring, I call it they call it services and non-software. Mystery shoppers. You've probably heard of these mystery shoppers. They're hired to visit client locations to give feedback on customer experience, so that their clients can respond quick to either maybe fixing things that aren't going well at the location, and to improve the customer experience and drive sales and increase brand loyalty. You look at that's actually on like the brand, the retail side of things, driving sales, improving efficiencies from that point of view. But when you look at, they also have this this recurring non-software inspection audit services. And I really like this part of the business. It actually sets them apart from other pure software plays. And I'll tell you why that's important later, but just keep that in mind here.
Now, real quick, sorry to interrupt. The restaurant angle here. Go through that real quick, because most of their clients are in the hospitality business, right?
Yeah. So if you go to but if you go to, I'll go to the customer slide here. So you look at some of their here's all their customers. For Fortune 1,000 customers, 300 really good brands. Retail, food service, petro convenience. So you can see those will all be affected. Educational, they're closed. Pharmaceutical, automotive, financial services. So that's kind of where they play in. But they in response to COVID, they came out and they slashed 50% of their the infrastructure, the cost infrastructure. Mm-hmm. So and they don't disclose where the percentages lie in terms of where revenues come from in terms of that. But I'm assuming it's a pretty big chunk, maybe 50%. From these very COVID-sensitive industries.
These are some pretty. If you look at the next slide, these are some national brands here.
Yeah, national brands here. I mean, these real strong brands. So I think when COVID, these are not little mom and pop shops we're dealing with. I think that a lot of these companies are already getting their PPP, stimulus, of course, on these public companies. So that's already set in place. And I think, as I'll explain later, why these. Actually, I think the company is really well positioned to benefit from the new industry kind of regulation and fallout from COVID.
Okay.
Yeah. So.
Interesting. Okay.
Yeah. So when you look at this audit compliance, what they do here, so it's done they do it for I guess two general buckets of compliance, and they basically do well, let me go back up here. I'm sorry. Yeah, this will start here. So it's basically the one part of the inspection and compliance services is really to help the company improve operations by visiting visiting their locations to see if their processes are actually working correctly. Whether it's the brand messaging, inventory counts, making sure the pricing is right on the product inventory. And even health and safety. So that's really simple there. And then we go over here. They also do some more like regulatory compliance kind of audit visits, age verification, alcohol and tobacco compliance. Again, health and safety, educational and testing, making sure that the SATs are being administered properly, that there's no cheating going on, and then some prescription drug and marketing compliance things. To make sure that drugs aren't being sold on the ground, and there's regulation that they kind of help companies make sure they're following there.
Is this the type of thing that you expect might be as we recover here from the COVID-19 crisis and people start going back into these retail outlets? You expect there to be some increased kind of scrutiny from regulatory agencies and others that might result in more order flow to this company?
Yeah, I do, and I think that let's go to the industry real quick. That's a good segue to that. So when you look at the industry, it already was poised to grow, and now there's back and forth on, is customer experience, management really that important? And when you look at some of the stats, it kind of supports that it is. Furthermore, if you look at the company's history, they have very, very little attrition over time, virtually no attrition. I think 97% retention rate of customers. So that tells you the customers like what they're doing. That to me is all I need to know, really. But if you want to look at the stats, I mean, you can look at next to price, customer service is the biggest factor that affects sales conversion, client satisfaction, brand loyalty. 90% of the customers will transfer to a competing store if they feel unhappy with services they receive. So now even with social media, millennials, this is even a more important kind of, I think, service they're providing there. You look at the actual industry itself. It's expected to reach $23.6 billion by 2027 for a CAGR of 17.7%. I think that's a period of 2018 to 27. The U.S. is the largest market. And they actually play in the U.S. and Canada. So that's where their major markets are. Basically, all of it.
So this is one of the rare companies that they don't have a international market at all, right?
They don't. Yeah, it's big enough here in the U.S. And I'm not saying they won't go there, but that's definitely a good point.
Mm-hmm. Yeah, especially with all this reshoring stuff that's going on and the that we keep hearing about. But yeah, go on.
And the budget. I mean, before COVID along came, you can see here. I mean, U.S. companies are going to spend $6 million to fund, these kind of activities. 2/3 of they call it CX leaders are the people who are in charge of doing this. Expect budgets to increase in 2020. So that was before COVID. So you think, all right, what does COVID mean? So there's going to be a need, probably, for more regulatory of a compliance, be COVID compliant. But a lot of these companies come out of it, and even if there isn't, I think consumers are going to demand it to make sure that companies are, certainly doing what they can to keep the experience safe. And I came across this little screenshot, which is pretty interesting here. So when I was looking, for some over the industry, and this thing that popped up right here, basically talking about, what we just talked about, how this is really going to force organizations to look at the business plans and assess their, the way they present their locations in terms of safety to like pandemics and COVID-19, these kind of things. So that's how I think it'll happen there. Yeah.
Let's talk about the valuation then, real quick.
Yeah. So if you look at the valuation, so let's go here. So I think it's the right bet at the right price. I mean, I think the company's going to adapt to COVID-19. You have a unique opportunity to buy a stock here at 60% lower than where it was just a month and a half ago due to short-sighted investors. And just a re-rate of the stock should get it back to, even though I'm looking at this long-term play, I think as we get more clarity after this stock, we pretty quickly get back to 70 cents, maybe within the next 3-4 months if we start getting some clarity on what's going on, maybe a little longer. But if you look at the valuation and the comps here, you'll see here that Insight, the stock in this, the last column there, is trading
no debt. Yeah.
No debt. They're actually profitable. The other three there aren't profitable. Even the company that's more similar to them in size, which has debt, not profitable at all. And so why is trading a much higher rate? So why is that, right? You see, why is that happening? And I think so. The three comps there are pure software plays. So before 2013 and before Cameron James Watt came to be the CEO, it wasn't really a software company. It was more of, hey, just collecting the data, right? Collecting the data, and then the client would just use their own probably software to do a lot of the analytics and stuff. So he made a decision that, hey, I want to turn this into a software company. And that's a good segue into software here. So if we look at they have a recurring part of the business, which is about, I think, 15% of their revenue. So we go here, the revenue mix, you got 64% US, 36% Canada, but you got recurring services revenue is 85%, which is what we talked about, the on-site kind of compliance and mystery shopping revenue. And then the recurring software is the newer kind of focus of the company. So that, they get these online surveys on websites, event software, and mobile forms. So let me go in which one of these three real quick here. Online surveys, obviously, you go to a website, you fill out a survey, right? Event software, let's say you go to an event. You've seen those individuals that have like maybe a mobile pad, and you fill out a survey there. Mm-hmm. Then boom, that's what that happens there, and that all feeds back into the client's kind of own maybe software system. And then mobile forms actually is more of on the compliance or regulatory side, where on the operations side. So when the field officers is visiting a particular location, they're having their employees actually fill out surveys, so they get employee feedback, what's going on. So, let's take an example, like if you're at a car show, right? And you're there and you fill out a survey right there. The software integrates with maybe the auto dealers CRM, which is able to give real-time feedback to the associates at the car show, for example. Maybe to book a ride, right? Or maybe to schedule another visit to to the dealership to see a car or something. So that's how that works. So the interesting thing here now is that, okay, we have it, and it's a very small part of revenue. So how can you value that up? 4x, right? 4 times revenue, 6 times revenue. The market doesn't want to do that. But when you look at how important the data is here, all these years that the company's been collecting data, and that part of the business is very important, and it all works together. And there's gonna be a lot of cross-selling opportunity. And when you between all the companies, just current companies, the current customers that are using their field kind of services now are going to be able to have software solutions. They can cross-market that whole customer base, and they just basically, I think it was 2018, after a few years of development, launched their LEA CX SaaS application, and all their software, by the way, is SaaS, recurring revenue. And LEA stands for Learn, Interpret, and Act. So now they finally have a actual analytics kind of component to the software. Before they didn't. They did, but it wasn't that great. Most of the clients would use their own data analytics kind of software or their third-party software. Now they can say, hey, we have this more comprehensive software solution that has more touch points to get, to be able to actually monitor data, get data, and analyze data, and it integrates with all the other companies' software products. So it's really, really cool. And I don't think that the market understands that yet. It's a relatively new product. And so I believe that even though the company has these non-software type of services, it all works together, and I think it is worth 4 to 6 times revenue at some point, which is why I think there could be a big re-rate in the stock to over $3 a share, just on the current revenue. Not even talking about growth at all. And once the company does a better job of getting that out there. Now, when you look at the revenue, let's look at some of the financials here real quick here, man. So you have zero debt, working capital $2.9 million, 8% increase over 2018, current ratio 3.2x. They have $1.4 million in cash, operating cash flow is positive $1.5 million, gross margin 52%. So I think they're well positioned to weather the COVID storm. And you can see the transition they made here from 2018 to 19 for COVID. So they're really starting to hit in all marks there. The revenue was $19.3 million in 2019, up 30%. Most of that came from the service revenue, and that's another reason. Problem with this, the multiple isn't that great because the software revenue only grew maybe 4% to about $2.5 million or something. So why is that? Because they really just started pushing the software revenue in 18 because once they had that LEA CX thing ready to go. Furthermore, there were some some mistakes they made along the way with their sales and marketing. They originally built an infrastructure that was to scale, but the company wasn't ready to scale yet. So there were too many costs involved within the company, so they cut that back. So when you see the OPEX percent of revenues went from 70% to 48%. They were actually cutting back on a lot of the marketing to get the right size of the company. So now that they've done that, they can ratchet that up again, and hopefully start seeing growth in their revenue in their software side. And the cool thing about the LEAC, not only does it give you cross marketing within your own organization, Nathaniel, it actually allows them to go get new customers. They can say, okay, you know what? You might have your own data. Stick it in this program now. Stop using third-party software. Use our great software platform. We understand data. We've been collecting data for years. You get them in the door, and now they can cross-sell those customers to their service, to their on-field and service revenues. So it really, I like the way that whole that dynamic works. And furthermore, the LEAX allows them to go after other industries that aren't as sensitive to retail, outside of retail and some of their more traditional industries.
Okay.
So you really, this is what we call information arbitrage. At the Geo. We just try to really go in there and find these little clues that really are misunderstood. So that's basically the pitch. Let me go through here the slides. If there's anything else interesting else to talk about.
Okay. Are there any questions while you do this? Please message them to me as everybody's muted. And if not, Matt Zablosky, I see two different Matts here. I'm not sure which one is the proper one as far as our next presenter. But
okay.
So this is interesting. How did you find this company?
I just was I was just running a low EV to revenue screening software, and it came up. I was under one, less than one, EV to sales under one, little debt, software screen, and this came up.
Nice.
And when I saw the valuation, when I first found it, I wasn't as excited. I wasn't, wow, this is great because the software isn't growing, and it's a small part of the revenue. But then we started looking into it more. I said, wow, the key, a big key to success in a lot of these small nano cap, micro cap, software transition companies, getting them early when no one really sees the transition yet. And we've had a lot of success. GeoInvesting is sniffing out these recurring revenue kind of software transitions, and you might have to wait a little bit for the market to find them. But if you wait too long, you're never going to get these kind of valuations that we're getting here in terms of opportunity to buy these valuations. So I think this is a pretty awesome opportunity.
Very cool. All right. Are there any other questions for Maj? I do have one here. What are the factors that you think will make this company a positive cash flow company during the following years instead of a volatile cash burning company?
Well,
fair enough. Yeah.
So if they went to that's a good question because they don't have their history in the past is kind of volatile in that respect. But I think now with a more consistent asset light software type of model to it, that the cash they'll maintain positive cash flow. I just think of all the cross marketing opportunities they have now, will have more consistent revenue growth, more consistent growth in general. And I think they'll be able to maintain profitability and cash flow outside COVID, of course. The software revenue is going to be a lot more scalable for them. So a lot of that revenue will drop to the bottom line. So I'm very confident about that, actually.
All right.
If I want to just make a disclaimer here real quick. We have a disclaimer.
Yeah, go for the disclaimer. Then we have another question.
Just make sure if you read the slide, if you go through the slide deck and look at it, you read the disclaimer on page slide deck number 29. And this presentation will also be at I'll put it up at GeoInvesting.com. I also have a small video I made about the company, which goes into COVID, how they actually earn their fees and make their money. So the one thing I wanted to really say to you real quick, Nathaniel, is that their contracts are longer term in nature. They're obviously they have annual contracts with the software. Even their service contracts are 1 to 3 years. So.
Okay. There was another question here. Lastly, why is this company in the OTC? It seems Nasdaq worthy based on the clientele.
I think it is, and I think that's something they're going to be working on. So yeah.
Okay, cool.
I don't think that the story wasn't fluid enough yet for them to go and predictable enough for them to make that move.
Mm-hmm.
And I believe they were probably going to do that or on that track before COVID. So I think
very good.
That will occur.
Okay, thank you, Mash Soueidan. And here is the information on how people can get in touch with them. GeoInvesting.com. Been around, focused on this segment of the market for quite a while, 13 years. He's on the Twitter as well, Mash GeoInvesting, as are we all, I think. All right, our next presenter is Matt Zablosky, and we are continuing here a bit with the Canadian theme. Let me see if I can get him on here. I'll make this person, yes. So Matt, I don't know if you can hear me, but I cannot hear you. Maybe if I unmute you. How's that? Matt, are you there? Oh, here he comes. Okay, we can't hear you though.
Hear me?
Yeah, now we can. Go for it. This is still screwy though. It's all lopsided.
Okay, hold on 1 second. Can you hear me now?
I can hear you, but your presentation is lopsided.
It's lopsided. Okay. Well, that I will attempt to fix very briefly here. If not, we'll just talk to it.
Sure.
Give me 1 moment here.
I believe I have your presentation, actually.
If you have it, you can maybe just run it.
Yeah, hang on a sec, yeah. No, I have Hindenburg.
It's our beautiful city of Vancouver on the west coast.
Although it looks better when it's right side up.
It does. Although everyone's home now, so.
Yes, of course. I actually don't think I got yours.
Why don't I just email it to you very briefly?
Yes, send it to me right away, and then I'll put it up.
It's in your inbox now.
Okay, thank you. Hang on. Actually, I haven't gotten it yet. I haven't gotten it, Matt. Wait. I don't have it. You sent it with.
Why don't I just start and you can bring it
Yeah,
up?
go for it. Yeah.
Okay, perfect. Thank you for taking the time to have us this morning. I'll be brief. I had about 3 or 4 slides, and if you could bring them up, that'd be perfect. But we are a materials-focused hedge fund based in Vancouver, Canada, completely in the materials space. So basically anything from something like what we want to present to you today, which is Vale, $40+ billion market cap company based in Brazil. We cover bulks, iron ore, coal, gold, energy metals like uranium, copper, everything across the gamut, chemical, steel, etc. Our idea today for you is Vale, which is, as I mentioned, a $45+ billion company based in Brazil. Operations are global, but the vast majority is focused on iron ore production in multiple states in Brazil. Now, Vale is an interesting story. The company trades at a significant discount to the majority of its peers at the moment, peers being companies like BHP, Rio Tinto, etc. Vale had an issue a few years ago with a tailings dam failure. Tailings dam failure is, in essence, an area where mines stockpile their used material. They had a dam failure, which subsequently killed approximately 300 people. Huge liability behind that, to the tune of about $5 million, has sort of put Vale in the penalty box. Iron ore in general, and it's a great contrarian idea today as the Dow opens up down 2%, and we're pitching a long value idea. But iron ore in general has been very resilient. For users of the product, China, specifically steel production, more specifically rebar production, been a couple big construction governmental changes in China since earthquakes years ago that have led to rebar demand being very strong. In essence, what happened a few years ago in China. Oh, there you go. You can bring us down 2 pages if you don't mind. There you go. There's the iron ore price right now. As I was saying, in essence, demand in China has been very strong because of construction coating that's occurred because of previous earthquakes. In essence, the government's mandated that a large majority of buildings over 3 stories tall need to be rebuilt, and they need to include rebar reinforcement in order to meet certain technical standards, previous failures on earthquakes. So rebar production has been very strong in China. Globally, steel production still maintains itself. The vast majority of iron ore consumption goes into blast furnaces. Blast furnaces are a method of producing steel. Now, blast furnaces are large sort of beasts, if you will. And throughout the COVID crisis that we've had, we haven't had a lot of blast furnace shutdowns. Why is that? The main reason simply is you can't just turn a blast furnace off. You can't operate it at 25 or 50%. It's either on or off, and it takes a matter of weeks, if not months, to hone in on the proper production rate for blast furnaces. So iron ore has actually stayed relatively stable for the last few months. I believe it's down about 8% year to date. It's actually not bad for certain commodities if you look at copper, etc. So if you want to just flip down to the next page. Demand supply, as we mentioned before, relatively strong. The market for iron ore has been in deficit for years now. The tailings dam collapse that occurred at Vale both last year and a few years before, they've had 2, actually drew a good amount of iron ore off the market and has helped us to maintain this deficit. We monitor demand into China almost weekly, and it's been somewhat insatiable as of late, which did actually surprise us within our model. We're actually modeling a slightly lower iron ore price. But I believe what's happening here is a buildup of inventory in anticipation of a massive government stimulus plan to help the country recover from the COVID-19 situation there. In addition, I think you'll see those type of infrastructure plays from the governments in a variety of different countries, including the U.S., which should further support steel and iron ore consumption. So we really think that Vale is one of the best ways to play this situation. If you want to just go down one more slide. So here it is. This is Vale. It trades in New York. As I mentioned, about a $42 billion market cap. Also trades in Brazil. The company is very liquid, has about an 18% free cash flow yield before you account for the liabilities from the tailings dam collapse last year. Interestingly enough, we don't do a lot of investing purely, speculating on commodity prices. We try to find a catalyst. So the real catalyst for Vale is going to be this summer. It's anticipated to be allowed by settle the liabilities from the last tailings dam collapse, which is phenomenal. Look at that off the balance sheet. It's about $5 to $6 billion. And what we'll end up seeing is the company paying a massive amount of money back to shareholders through both dividends and share buybacks. We estimate the company could probably pay back its entire market cap in 2-3 years in dividends alone. So this is really a free cash flow generating machine, which we believe is underappreciated and undervalued in the market. If you look at the comps, as I mentioned, and I've lost the presentation, but BHP and Rio trade at about 2 times the value of Vale right now. So we really see upside for Vale being quite material in the next 12 to 24 months. Within Delbrook, we invest in 3 buckets in terms of strategies, event-driven, relative value, and longer duration capital. This would meet our longer duration capital bucket. We've begun to acquire shares. In general, if you look, perfect, that's exactly where I wanted you to go down there. Year-to-date performance, it's underperformed its peers quite materially. Trades at trough valuations. We're talking about, a company that we're now being increasingly, high conviction on alongside trading at 3 times EBITDA. Even on a stressed basis, as we look at iron ore prices, let's knock 20% off, and trades still materially cheaper than its peers. Let's call it 4 times EBITDA, with the big catalyst coming down the pipeline in the next couple of months, which will be the ability for this company to resume dividend payments, which we think will attract a variety of institutional investors back into the name. So we're quite supportive of the outlook for Vale. We are positive to neutral on iron ore, but we think this company at the current market price is an absolute steal. And I pitch it to you the day that the Dow's down 2%. So, over to you if there are any questions on this, but we're quite convinced that this is a company that will have material upside in the next few years.
Very cool. Thanks, Matt. So what do you make of so this company still is tied to commodities prices, and is there any concern here that you mentioned Chinese demand and such, that any of this can kind of go away, or it already has gone away and not come back with the coronavirus, right? How much of a concern is that?
Look, we've seen continued buying of iron ore. For us, we're not, let me just reiterate, we're not trying to play a commodity, bounce here or stability. In fact, the trade that we're looking at the moment on this would be something like a long Vale and short BHP.
Okay.
So let's strip commodity prices right out of this, and appreciating, the likes of Vale and BHP have multi-commodity exposure. If you want to hedge a position here, we see 50% relative value returns.
Mm-hmm. Wow, that's pretty aggressive. How much upside is there in this stock, do you think?
As a pure long, I think at the moment we have this thing at a $15 price target, which, off an $8 base right now is,
so it's almost
100%.
Yeah.
I think the big catalyst is, you reset your expectations based on COVID. Let's look into, July or August when they strike a final settlement on their dam failure with the Brazilian government. They pay out the last sort of $5 billion, and they are allowed to begin to pay dividends again. That to me is sort of a key event, and it's a lot closer than people think. Now, the one thing I tell you, just from a valuation standpoint, I mentioned previously this company has about a 17% free cash flow yield. Even if you adjust for the liabilities they're accruing for tailing dam failures, that free cash flow yield is about 12%. So, in general, this is, amongst the cheapest companies out there with iron ore exposure. But for us, it's, really just about the metrics. It's free cash flow yield factor buying at 3 times EBITDA. Iron ore is hung in there, but even if we stress that in our model, we're still buying something well below 5 times, with a catalyst being a huge return of capital to shareholders.
Mm-hmm. What's this company's balance sheet like? It looks here like they have quite a bit of debt.
Now, it's less than 1 times EBITDA.
Oh, okay.
Yeah, so yes, there's, $8 billion or $7 billion of debt. But, the fact of the matter is these guys will continue to produce significant free cash flow.
Very cool. All right. Are there any questions from the audience? Yeah, we apologize for the poor volume, Matt. You're in and out there, but I think we got the gist of it. That's okay. Yeah, let me see here. I'm not seeing any questions from the audience besides what I asked. Right. Not sure what else there is here. All right. So we'll just give another minute or two for questions, and I can think about something I might ask as well. So you guys also are in Canada, in Vancouver. There's quite a few hedge funds up there, and there's not all that many, obviously, compared to New York or Greenwich, but Vancouver does seem to attract a lot of commodity specialists, right?
It does. We are, however, one of the only pure commodity hedge funds based on the West Coast.
And you can see here that it does indeed look a lot nicer from this perspective.
Not today, but no, in general, it's a nice place.
Right. I guess I was referring to this photo, but yeah. Cool. Okay, well, I think that if that is all the questions, or if there are no other questions, we can leave it there. Again, the slides should be available to participants, and also the recording should also be made available. Again, apologies for the technical issues. This was the first time for us doing this. It was a bit of an experiment, but I think that in the end, it was successful and yielded several very interesting stock ideas, many of which have already moved in the pre-market and actually in the early minutes of the open, since we opened 12 minutes ago. So this is all very interesting stuff, and I think that we'll just leave it there for everybody. So thank you all, and any questions, I am available, as is Jacob, and let me see here, Matt, if you want to unshare your screen. So yeah, that will be available for any questions, and of course, don't forget to follow us on Twitter. And lastly, I'll just throw out a plug for valuewalk.com, as well as, of course, for my own podcast, the Contrarian Investor Podcast. Matt was on there. He was actually one of the first ones that I had on there back a little over a year ago. And you can find out more there on contrarianpod.com, as well as download it from iTunes or subscribe the other, Spotify and what have you. Okay, guys. Well, thank you again, everybody. Thanks for all. Certainly, big thanks to all the presenters and for everybody for participating. And again, we hope we provided a value here, and look forward to doing this again next time. And any questions or concerns or anything, please don't hesitate to get in touch at all. So that's all. Thanks, guys.